Hello, welcome back. In this context, I would like to discuss how you can use the investment property strategy to get financial freedom. I explained the power of leverage to acquire real estate and how the current high inflation has affected real estate investment and what strategy to use to help calculate which property is a good investment. Also watch towards the end how I use a CAP rate ROI calculator to compare 5 properties return investment. The calculator will break down which one has the highest return on investment. First, let's discuss what is leverage. Leverage is the strategy of using borrowed money to increase return on investment. In more detail, it is an investment strategy of using borrowed funds, debt, to increase the potential return or capital gain that would surpass the cost of borrowing. There's a good debt and bad debt. Leverage is not necessarily bad debt if used correctly. It multiplies the value of every dollar of your money you invest. Leverage is from the Latin word levar, which means to raise. In physics, this technique is named after a lever which amplifies a small input force into a great output force. How to use leverage. When you buy a house, you're taking a mortgage loan money from the bank. You're using leverage to buy an asset. This case, the asset is a house. Over time, the value of your home could increase, also called appreciation. Home appreciation is when a house or investment property increases in value over a period of time and leads to more equity in the home. Equity is the difference between how much your home is worth and how much you owe on your mortgage. Use the power of appreciation, inflation of real estate, and cash flow to get you rich. Inflation is great when you have assets. If you put 20% down payment on a home and it goes up 3% per year, that's automatic 50% return on your investment. With the current high inflation, the Fed is trying to bring down inflation. For the Fed to bring down inflation, interest rate must stay high to make borrowing for personal and business more expensive. This will slow down the money supply and reduce the liquidity in the market, hence affecting home appreciation and borrowing costs. Looking at U.S. National Home Price Index, you can see the home appreciation level has leveled off the last year or so. If you're investing in real estate for appreciation, the appreciation return will not be the same or similar in the last prior several years. Instead, look into the ROI return and concentrate on cash flow, rent, and bargain homes. With interest rate being high, cash flow and bargain home prices will be your 2 criteria that will give you a good return. Let's look at the CAP rate ROI calculator. ROI is net income divided by the total cost of investment, or ROI. Net income divided by cost of investment times 100. Here I input 5 properties with each different purchase prices. All the expenses are similar except of course the rehab costs for the older properties will cost more to remodel older homes of course. Cash flow will also change due to the location, how new home is located. As you can see that it was adjusted for. After inputting all those data, you can see that property number 5 shows the highest CAP rate ROI. Property number 1 shows the highest appreciation return, of course, because you're using more leverage on property 1 due to the high purchase price. Once you add both the CAP rate and appreciation together, property number 5 has the highest return on investment. Going back to what was mentioned earlier, the calculator shows cash flow and bargain homes are your best return on investment. Successful financial leverage requires small amount of money needed for borrowing to create large amounts of profit. There is a risk involved in financial leverage. The risk of leverage is investing in debt and losing what you borrow. It can result in losses when there is a decrease in value and profit made from the cost of borrowing to lesser than the interest payable. This is true for an investor who is purchasing more than they can afford. With that being said, analyze your finance leverage by seeing what percent of assets have been purchased using debt. If the debt to asset ratio is 0.4 or 40%, it's considered minimal risk, strong financial health and growth. Debt to asset ratio above 40% is considered high risk and may discourage future investment from getting loans. Before you leverage, do your research, perform a risk assessment. Make sure your debt to asset ratio is minimum risk. Look at your ROI, return of investment, and make sure it is above 10%. At 10% annual return, your investment will double every 7 years. The compound effect, snowball effect. Financial leverage is a powerful tool. If used correctly, will allow you to earn income from assets that normally you would not be able to afford. Money can't buy you happiness, but it can buy you a lot of comfort. And it can make your life much easier. And to get there, invest your money and let your money grow while you sleep. Take care and bye for now.